I'm not sure there's any any problem with recording them, but it weirds me out that we have video in our sacrament meetings and things like that. I'd just still old fashioned about it, I guess. So just a couple of general announcements. First of all, so everybody turned in or almost everybody turned in their first draft of their paper. The announcement I want to make is I'll just be honest with you. This isn't an English class, okay? So I'm not going to grade anything like hard, okay? Honestly, there's a format where it tells you to, in essence, tell why you wrote it, and then something you learned about. You just share it. If you just follow that and be part of the peer reviewing process, which is part of BYUI's learning model of learning together, and make a few adjustments, you should be good. Like, I'm not going to read them hard. I'm not going to slam you for them. And so I guess what I'm trying to do is take any anxiety you might have out of that process. To me, it's more like if you follow the instructions, it should be easy points compared to some of the other things that are not as easy, like adjusting entries, right? Less easy. Anyway, so that's kind of just my general announcement on the paper is don't worry too much.
They're not. It says they're connected to this.
All right. Any questions about, I guess, general type things like that, assignments coming up or things like that, not specific accounting problem questions? All right. So hearing none, sometimes it's like rude to just launch into my lecture piece, and then people are like, I really just needed one question, and then I had another thing to get to. So I just want to put that out there.
I'm sorry, you said the non-accounting question, or?
Yeah, so anything that's like more general, not about a specific problem or specific question. So it can be accounting, I guess. It just not specific to a problem, because we're going to look at those after this little.
Yeah, mine is where do we submit our paper for the peer review? I can't find it. So okay. I don't know where to upload it so people can view mine and vice versa.
Okay, so by submitting the assignment, you submitted for the peer review. So you did that just by did you submit in the week 4 paper? I forget what it's called, first draft or whatever it's called. Yes. Yeah, by doing that, you did. So, and then the instructions for the peer review, which confuse everybody all the time, but it'll tell you to go back to that week 4 and click on it. In fact, would that be helpful if I showed you how to do that?
Yeah, I was under the impression that we were supposed to read other people's papers and give feedback. So yeah.
You are, yes.
Okay, yes.
So let me show you how to do it. That's a good idea. I'm going to share my screen with you, because it really does. It confuses people every semester, the way it's structured or something. So I'm going to go to the modules, and then I'm going to go, so like week 5, where is it at? Where's the peer review at? Week 6, paper peer reviews. So when you click on it, it just gives you all these instructions, and people get lost in this big list of, I don't know how you guys are, but if I see a bunch of text, I'm just like, nah, I don't have time. And I have to really force myself to read it. So it says after the due date's passed for this one, you it says go to that assignment and find your assigned peer reviews. So that is kind of confusing. So go to that assignment means go back to the week 4 paper initial assignment. So I'm going to go in the modules, and then I'm going to go to week 4 and go to that paper initial submission. And then up here, there's this little peer reviews link, and you'll click on that, and you'll see that like I've got everybody because, because I'm the teacher, but you'll just
on our end. Sorry, I don't mean to cut you off. On our end, it'll have 2 people just right there on that right-hand side, and you just click on their names and it'll upload, you download their document. So
okay, so it's even easier than that.
Just for reference. Yeah,
so
so there's no peer review to click on.
Okay, so when you come to this point, you'll see over here 2 people, 2 names. Jessica, yeah.
Yes, 2 names.
And then again, so in the instructions, it tells you that there's a little rubric thing you have to do. And And what happens is sometimes people will go in there and they'll make comments to the other person, but they won't do that rubric, or they'll do the rubric and won't make comments. And then on my end, it looks like they didn't do it. So you have to do all the little things it says in the instructions. So then what happens is I go and I see they didn't do it, I put a 0, and then they send me a nasty gram saying, I did do that. And I have to go back and manually look at each one and say, oh, okay, you just didn't do the rubric or whatever. So just follow those instructions to the letter. And if it does happen that, you know, you did do a review and did give comments and you forgot to click something, don't worry. I hope by now you figured out I'm not out to get anybody. I'm trying to help. We have enough hard stuff in this class to let you lose points on easy stuff, you know, on these little, I mean, they're important, but peer reviewing is a good thing, but I don't want to kill anybody there. So thank you, Jessica, for that. It's sometimes hard with Canvas because my interface is slightly different from your interface. Like you probably can't see all these things I have on my end because it's an instructor login. Anyway, so it's a little different. All right, other questions that I can attempt to answer, and then Jessica will actually answer correctly.
No, I was gonna add just one more thing. I remember on a class that I took where we did lots of peer reviews, I remember we had to make a comment to like for it to submit. So I don't know how it will be in this course, but just if there is an option to write a comment, just say, hey, good work, or here's your paper or something like that, just so that it submits successfully. I don't know. That might not be the case for this, but I
think it
remember
is,
that was
Jessica. I think you
that
do
was a
have to
thing.
I think you do have to make a comment and then click save, and then it will submit
Yeah,
it for you.
upload.
Let's see. Open your first assigned peer review. Oh, and read your peer's document. Provide your critique by annotating directly on your peer's document. Include the following. Complete the rubric, add comments.
Oh,
And I
yeah.
believe it's
Add a
that
comment,
add
yeah.
comment part that people miss, because they're like, I wrote in their paper and I did the rubric, and then it still didn't recognize it as done. And it's this add comment. And I mean, it could be as simple as like, hey, I made comments in
go.
your paper, right? Or like,
Yeah.
or whatever.
Well, you have to rate the comment, but you also have to click that save button down below the comment box.
Right. Okay, good. So click save button. So follow these steps, I guess, is like the most important thing.
So
Anyway.
if we did that a little bit late, do we need to let you know that?
If you did what a little bit.
I totally missed that last week.
Well,
No, this is for week 6.
Yeah, this is for
Oh,
week
is this
6.
the week? Okay,
So it's
good.
next week.
Next week.
Yeah.
All right.
But it's something coming up that throws people off every semester. So I wanted to address and appreciate your questions.
Thank you.
Also, I think, if I can interrupt, the assignment says week 4 in the grade. I was just looking at the grades and it says week 4, so it's extra confusing.
Well, the paper is week 4, and then the peer review is week 6. But the only way to get back to the paper is to go back to week 4 to get to it. So it is extra confusing for sure.
If you see it in grades, it has a week 4 in there.
Okay. They also had some weird thing going on where I guess it was course design when they set it up or something. They put like the due dates were off on the little quizzes, the homework support prep or participation quiz, where you just go in there and say like, yes, I looked at people's things and commented. And so like they had it so it wasn't opening until like the Saturday after and stuff. So I fixed the next couple weeks in ours and then sent a course fix in. So hopefully that will be fixed. And on last week's, where a bunch of people clearly went in and made comments but didn't have it because they couldn't get into it, I just went and gave everybody, it's 1.6 points or something like that for that homework support participation. So hopefully, as always, if there's something wrong with your grade, there's been a few people who like it's not transferring over from Wiley Plus to the grade book correctly. Don't be afraid to let me know. Or if you're, I can always go in and manually fix stuff. Anyway, so I appreciate that while you're here to learn, that's important, that also your grade's important to you too, and you don't want to get, you don't want to miss points that you didn't have to miss. Okay, so let's take a look at accrual-based accounting versus cash-based accounting. With So this is always like one of the hardest chapters for people, just because it doesn't seem as intuitive as some parts of accounting do. Um, if you think about it, we're accustomed to cash-based things. You know, when I lived in Texas and I was a broker for Edward Jones, I had clients who were like ranchers and they did everything cash. I mean, like legitimately, they took a wad of cash and put it in their bib overall. And then when they bought stuff, they'd like pull that wad of cash out and pay. That was expenses. And when someone bought a calf from them, they'd take the cash and put it in there and put it in their pocket, and that was revenue. And like that makes some sense, but it doesn't work because we have assets that sometimes last longer than one accounting period, right? So we have to show that we're using those assets up and claiming the expense for them over time. Sometimes we get paid for something, but we haven't earned it yet, and so we can't record it as a revenue till we earn it. Or sometimes the opposite happens and we've earned it, but we're not going to get paid till later. So we need this accrual-based system to make our revenues and expenses match up to the times when we earn it and incur the expense. So under an accrual-based system, this is really important to recognize, is that revenues are recognized when the services are performed, even if the cash is not received, and expenses are recognized when they're incurred, meaning when we've received the benefit from them. So that's how accrual-based accounting works, as opposed to cash-based accounting, which is revenues are recognized when the cash is received and expenses are recognized when cash is paid, regardless of when we get the benefit from it. And so GAAP, or generally accepted accounting principles, doesn't allow us to use cash-based accounting. Now, some very small businesses, let's say you have an Etsy page or whatever, and you're selling stuff on there, and you sell $1,000 worth of stuff a year or something like that. Then they don't usually mind you using a cash-based system because you're filing on a Schedule C, that small amount of income. But I own a small storage business, and we honestly do about $20,000 in revenue a year. We still use an accrual-based system to recognize, to match the revenues with expenses. So here's like a little example. Fresh Colors paints a large building. It incurs and pays all the expenses in 2016. Let's see, so we have salaries and paint costs of $50,000, and it bills the customer $80,000, but does not receive the payment until 2017. So under a cash basis, they would put all that expense, and so they'd have a loss of $50,000 in 2016, and then they'd put all that revenue when they received it in 2017, so they'd have a net income of $80,000. And so that just doesn't make sense. You need to match the revenues or the expenses to the revenues they earned, right? It costs money to make money, so you want to match the revenues and expenses together. Really what happened is they earned that $80,000 in 2016, and they incurred all the expenses of earning that $80,000 also in 2016. So we're going to record our revenue under an accrual basis in the year it was earned, even though we haven't received the money yet, our expenses in the year they were incurred, and then our net income. And that's a more accurate reflection. And certainly from a tax standpoint, it makes more sense. Also, if you have a question as I'm going, don't be afraid to ask. I don't have my chat up though, and sometimes people are more comfortable asking in a chat, just because it feels like it's not interrupting. So,
Brother Fox,
yeah.
Can we go back to that slide for a second?
Sure. I would love to go back to that slide. Let's see. This one?
Yes. Okay, so how, and again, I'm just going to make this right in my brain, but so in that 2016 accrual basis where you're showing a net income of $30,000, but you haven't collected anything, isn't that, I guess in my mind, for the asset side of things or income, we're reporting $30,000 of net income, but we haven't received it. Is that not going to skew things a little bit just as it would on a cash basis?
So no, because we're going to have an asset called accounts receivable.
Okay, so we
for
stood,
that.
record that in the AR. Okay.
Right, right. So yeah, when we recorded that revenue entry, we would have debited accounts receivable and credited revenue.
Okay, I just knew
Yeah.
something else had to happen there. I didn't put the, okay, very good. Thank you.
All right. So unfortunately, though, because we want to make this all match up, we are stuck having to do these adjusting entries. So what an adjusting entry is, it's an entry that we make in our journal at the end of a period, usually the end of a month, unless you do quarterly accounting, that's the end of the quarter, or yearly. But typically it's monthly for most businesses. And so at the end of each month, we have to recognize any of these revenues or expenses that we've earned during the period but haven't received cash for, or the opposite. So there's 4 types, and they're broken into 2 categories. The first are called deferrals, and the second category is called accruals. So to defer means like to put something off, right, to a future period. So when we say there's a deferred expense, what we mean is that we are going to pay the cash ahead of time, and doing that creates an asset, okay? And then when we use up that asset, we record that as an expense. And I'll give you some examples of each one, but that's generally what that means. Unearned revenues is where we receive cash ahead of time for services we've not yet performed. And then later, we're going to recognize the revenue for those services once we perform them and reduce. And when we do this unearned revenues, it creates a liability. So if someone gives me cash, my asset cash goes up, but the other side of that is that my liability, unearned revenue, goes up because I owe that service to the client. Then later, when I've done the service, I'll record the service revenue and reduce that liability. So deferrals involve receiving, either paying cash ahead of the expense, and then the adjusting entry is to record the expense, or receiving cash before the revenue and later doing the adjusting entry to record that revenue. So those are our deferrals, putting off the expense or the revenue till a later period. And then the accruals are the opposite. This is where we recognize revenues for services we've performed, but we've not yet received cash. And so we'll get cash at some later period. This happens most often like a lawyer's office or an accountant's office, where we do work for our clients all month long and just sort of keep track of it. And then at the end of the month, we add up the number of hours and bill the client. Well, at the end of the month, we want to recognize we've earned that revenue because we have. And so we'll bill the client, record it as revenue, and accounts receivable. And then accrued expenses are those expenses we've incurred, but we've not yet paid in cash. The most common examples of these are things like salary and wage expense, where each day our employees work, they're earning money, but we don't pay them until payday. And so if they've earned money up until the end of the month, but payday is not until the 1st or sometime in the next month, maybe the next Friday. A lot of people pay on Fridays. Then what we have to do is record the expense for the amount of labor expense we've incurred during that month, and a liability called like salaries payable. And then later when payday hits, we'll actually pay them. So accrued revenues mean that we have not received the cash yet, but we've earned them. And accrued expenses mean we've not paid that yet, but we have incurred those expenses and we'll get cash later. Does that make sense? That was a lot of talking.
Brother Fox, is one way to think of it as a deferral is essentially cash activity and an accrual is like an operating activity?
I'm not sure I'm comfortable with those terms. I'm afraid that like it might help you get it in your brain and confuse another, you know how like it is
Oh,
with
I see.
we all think differently. Honestly, a deferral just means the cash moves before and the expense of revenue occurs later. And an accrual means the expense of revenue happens before and the cash occurs later. So maybe I'm not sure I want to commit to the same
Will you say that?
terminology.
Can you say that one more time about
Sure.
the order of things?
Sure. With a deferral, the cash happens first, and then either the expense or the revenue occurs later. And with an accrual, the expense or revenue happens first and the cash comes later.
Would supporting a Kickstarter campaign where I pay for it this month and I don't receive whatever it is until November or later, would that be a prepaid expense? Where I'm
Do
paying
you get
for it
do you
now?
get some ownership in the Kickstarter thing by
It depends on
contributing?
the Kickstarter.
Okay, so yeah, in a sense though, if you were buying into something that had value right now, then doing so, you would create an asset called, future value of Kickstarter or something. I don't know what you'd call it, but and then so you'd want to record that expense. It just, investments are kind of their own little thing, which is why I'm well, let me give you some, let me go through some examples and it might help clarify. So prepaid expense is where the expense is paid before in cash before they're used or consumed. So the cash payment comes before the expense is recorded. These often happen with things like insurance, supplies, rent, equipment, and then the using up of long-term assets such as buildings even. So here's an example. So Sierra Corporation purchases supplies that cost $2,500 on October 5th. Sierra records the purchase by debiting the asset account supplies, and it doesn't say, but they credit cash, okay? This account shows a balance of $2,500 on the October 31st trial balance. An inventory count at the close of business on October 31st reveals there's still $1,000 worth of supplies on hand. So what they have to do is they get to the end of the month and they say, okay, our trial balance says we have $2,500 worth of supplies, but then we count up the supplies and we only have $1,000 worth. So we must have consumed or used $1,500 worth of supplies during the month. So we've got to recognize the expense of those supplies. So we're just going to do an adjusting entry that debits supplies expense and credits the asset called supplies. So that will now bring the balance of the supplies asset account down to $1,000 to match what we counted on hand. So every time we do one of these adjusting entries for a deferred expense, it's going to look the same way. We're going to debit an expense account and credit an asset account because these deferred expenses always involve the using up or consuming of an asset over time.
But before it's used, it's a cash and an asset, right?
Yeah, so the initial entry when they purchased those would be to debit the asset supplies and credit cash.
Okay, and it's always that. And then when it's used, that's when you adjust it to the expense. Okay.
Correct. Yeah. So with all of these, there's like an original entry that had to occur back when we bought the supplies, for example, and then an adjusting entry, which just means at the end of the month, we know that the amount of supplies we have does not match what's on the books. So we have to make an adjustment to bring that in line. And we do that by debiting the supply expense for the amount of supplies we used up and crediting the supplies account. So its new balance will match what we have on hand. All right, so this is a similar one. So on October 4th, they paid $600 for a 1-year fire insurance policy. They recorded the payment by increasing or debiting the prepaid insurance account and crediting the cash account. So that would be the original entry they made when they purchased the insurance. So the way this works is you create an asset called prepaid insurance. And then at the end of each month, we recognize we've used up a part of that asset by having insurance coverage for the month. So at the end of each month, we're going to do an adjusting entry to debit insurance expense and to credit the prepaid insurance asset. At the end of 12 months, prepaid insurance will be down to zero, right? Because we'll have used up all that insurance and we'll have to buy another year's worth of insurance. So anytime we buy something that provides value to us over a period of time, like this is a 12-month policy, rather than just taking all of the expense for it at once, what we do is we spread out that expense over the life of the asset. And then each month we recognize a portion of that expense.
So what would the
You do-
original recording for that be?
The original
Like when
entry
you-
would,
like when you paid the 600.
right. So the original entry would be to debit prepaid insurance $600 and then credit cash $600. That'd be the original entry.
Okay, thank you.
So that's just showing us what the T accounts would look like at the end of the month. The reason it's so important that we do this is because at the end of the period, we're going to make our income statement, our statement of retained earnings, and our balance sheet. So any expense we've incurred during the month, like this $50 in insurance expense, we need that to be correct on our income statement. So that's why we have to do these adjusting entries at the end of each month to make sure we've included all the expenses and all the revenues that we have. And then also to make sure that the balance of the asset is correct on the balance sheet. So there's a special type of deferred expense called depreciation. And depreciation is the process of allocating the cost of something over its useful life. Sometimes people think depreciation means we're tracking the value of something, but that's not always true, right? You could buy a house for $100,000 and keep it for 10 years, and then it's worth $200,000 because the market value appreciated. So depreciation is more about tracking the amount or the amount of the asset that we are using up over its useful life, not actual value. So for assets that are, we call them fixed assets, things like buildings, equipment, things like that, automobiles, we use special accounts called accumulated depreciation accounts. So with these long fixed assets, rather than just crediting the asset's value itself, when we do the credit entry, we'll credit the accumulated depreciation account that is associated with the account. Okay, I know that's confusing. What it means is, well, let me just show you the example and then we can talk about it more. So in this case, the depreciation on their office equipment is $480 a year. Divide that by 12, and that comes to $40 per month. So the original entry would have been when they purchased the office equipment, would have been to debit the office equipment account, which is an asset, and credit either cash if they'd paid cash or credit some type of payable account if they'd borrowed money to do it. So we enter this entry each month, a depreciation expense of $40, and then we credit this account called accumulated depreciation equipment. And so accumulated depreciation accounts are special types of accounts. They're called contra asset accounts. And all a contra asset account is an account that is linked to a specific asset and has its normal balance on the contrary or contra side. So in the case of an asset, it has a normal balance of debit. So the contra asset accumulated depreciation will have a normal balance on the credit side. And then when we do our, so there's our T accounts, and you'll see that rather than reducing the value of the asset, instead what we're going to do is slowly let it accumulate each month as we do these adjusting entries. The reason we do this is because often fixed assets or long-term assets are sold before we use them up completely. And so we have to know our cost basis, or sometimes it's called our book value, which is the cost of it minus any accumulated depreciation. So that's why we track accumulated depreciation separately. So on our balance sheet, it will look like this. Equipment, $5,000, less accumulated depreciation on equipment, $40, and then it will give the book value or the undepreciated value of the asset. Whew, that was a lot of talking. I'm so sorry, but this chapter just has a lot of info.
So can you go back to that other slide?
Sure.
Okay, I get where you got the equipment and the accumulated depreciation equipment. So what's the depreciation expense?
So Well, so we're actually debiting depreciation expense and accumulated depreciation on the equipment. So that's our journal entry. We're not doing any change to the equipment account.
Okay.
And so depreciation
this- okay.
expense is our way of saying, hey, I paid $5,000 for this equipment, but it would really screw up my books if I just took an expense of $5,000 that when I bought it, because I'm going to use this over the next 5 years.
Mm-hmm.
So the depreciation expense is us dividing up that whatever they paid for that equipment over the useful life of it. So we're gonna actually use the term, we're going to expense off the cost of that equipment over time.
Okay.
That way it matches up to the revenues we're earning from the equipment. So I have storage buildings. I have a storage business, and those buildings last me about 30 years. And so I'm going to generate revenue off of them for 30 years. So if I paid $30,000 for the building, I'm going to take an expense of $1,000 a year over its life, rather than an expense of $30,000 in year one and then no expense for the next 29 years. That's what
Okay,
this,
thank-
so that's what the whole depreciation process is about, I guess, is spreading that cost out. All right. Unearned revenues. These occur when we receive cash before we've earned the revenue. This happens most often in my storage business. It happens when people come and say, hey, we want to pay for a year's worth of rent at the storage. You know, it's only $40 a month, so they'll pay $480 and get a year's worth. I actually give them a deal with, like, for $440, they get a year's worth, right? But so I get that money, but I haven't earned it yet. I haven't provided the rental to them for a year. So I record a liability called unearned revenue. So my original entry would be a debit to cash. My cash is going up, and a credit to unearned revenue, which is a liability. And then each month I do an adjusting entry to recognize I've earned some of that revenue. So here's our Sierra Corporation. They received $1,200 for guide services. And then at the end of the month, they probably tally up their invoices and see that they've earned $400 worth of that revenue. So their initial transaction would have been to debit cash $1,200 and credit unearned revenue. And then at the end of the month, their adjusting entry would be to credit unearned revenue. So reduce that liability and credit service revenue, or increase the amount of revenue that they've now earned.
Brother Fox,
Yeah.
would Airbnb work the same way? Like, because people pay often for part of it in advance, you haven't done the rental yet, and then you would, I mean, total it all up, you know, you get some payment later, but some in advance, right?
Yeah, so yeah, usually people track that in an account called deposits, which a deposit is an unearned revenue, right? It's simply money that you've received but have not yet earned, and you're kind of on the hook to pay back at least a portion of it if they cancel or whatever.
Okay.
Yeah, that's a good example. All right, so there's our deferrals. You notice there was like 3 examples for the deferred expense, but only 1 for the deferred revenue, and that's because deferred expenses are by far the most common the adjusting entry we deal with. So with accruals, these are revenues that we have performed but not yet been paid for. And then for accrued expenses, these are expenses that we have incurred, but we're going to pay later on. Okay, I know I've repeated that like 100 times, but well, it's confusing. So sometimes it helps to have it repeated. It's like at conference, right, where they all give the same talk and you're like, okay, I'll repent, or something like that. Anyway, so accrued revenues, the revenues recorded before the cash is received. This happens in lots of ways. Here's an example. Sierra Corporation performed guide services for $200 in October that were not billed to clients. So usually on the end of the month, the accountant or the bookkeeper will go through, look at all the services you performed to clients, send out bills to the clients, and record it as a debit to accounts receivable and a credit to service revenue or whatever type of revenue it is. Then later on, the cash will come when the customer pays their bill, right? And then we'll debit cash and credit the account receivable account. Accrued expenses, same idea. Expense is recorded before the cash payment. Like I said, it happens often with salaries, but it also happens with utilities, taxes, right? Where you've incurred the tax because you've earned the money and you're going to have to pay it next year, but you don't pay it until tax day. So here's an example. Sierra Corporation signed a 3-month note payable. So this one's an interest-based one, and the amount of $5,000. The note requires Sierra to pay interest at an annual rate of 12%. So at the end of the year, they calculate, or sorry, this is the end of the month. They calculate what the interest would be on that for the month. This is an important formula they're actually giving us here. They're not presenting it as a different thing, but whenever we need to calculate simple interest, we always take the principal, or the amount that we've borrowed, times the rate, or the interest rate, times time, and we express time in fractions of a year, because interest rates are always expressed on an annual basis. So that's why they did 1/12, because that's 1 month out of 12. Anyway, so they're figuring out how much interest expense they've incurred during the month. They take the principal times the rate times 1/12. That gives them $50. And then they're going to debit interest expense and credit interest payable, because they probably don't pay the interest until the following month when they pay their payment.
So why does it say 3-month note payable when we are dividing by 12?
They do that.
Does that make sense? Like, that throws me off a little bit.
Yeah, they did it on purpose. It's obfuscating, right? They're trying to make it harder. So
Yeah.
So you might have a 3-month term on a note payable. You might have a year on a note payable. Whatever the term is on the note, you have to pay attention to how long is the term I'm calculating interest for here. All that 3 months means is that they have to pay it off at the end of 3 months. But
the annual rate is what to pay attention to.
well, and annual rate, and how long is the period I'm calculating the interest for here. So they said the note was signed October 1st, and I'm doing my adjusting entry on October 31st. So it's 1 month's worth of interest. And this is where, people often get, make mistakes, because there's a lot of little details to pay attention. You probably noticed that already in these first several chapters, that accounting is all about details, which is interesting because I don't consider myself a detail-oriented person, but I am about certain things apparently, because all of this came naturally, not naturally, it was hard at first, but it feels like it's pretty easy to me now. Hey, just do it for 20 years, then it'll be easy, like anything else. Piano is hard when you first start, right? Walking was hard. I'm watching my granddaughter go through that. She falls down a lot. Also, growing teeth is hard. All right. So Sierra Corporation, I mean, I don't know if you get better at it. Probably if I had to grow a tooth right now, it would still be terrible. Sierra Corporation last paid salaries on October 26th. The next payment of salaries is November 9th. The employees received total salaries of $2,000 for a 5-day work week, or $400 per day. Thus, accrued salaries on October 31st are $1,200. So 3 work days since the last pay period. So we're not going to be paying until payday on the 9th. So we've got to record the expense we've incurred during this month so that our income statement will be right. Okay. And so what we're going to do is we're going to do an adjusting entry to debit salary and wage expense and credit salaries and wages payable, a liability account. Then when we actually pay our payroll on the, whatever it was, the 9th, we'll get rid of that payable and pay that in cash, plus any money they'd earned from the 1st to the 9th as well. All right, so this is actually an important summary of the relationships, and it gives you what the adjusting entry is. Like, this is the kind of thing that I might take a picture of, or, I mean, it's also in the other stuff, but anytime we're doing a prepaid expense type of adjustment, which means that the cash was paid before the expense was incurred, the adjusting entry is going to involve a debit to the expense and a credit to the asset or the contra asset if we're dealing with a long-term asset. Every time. Anytime we have an unearned revenue scenario, meaning we received cash before we earned it, we're going to debit the liability unearned revenue and credit the revenue account. That's our adjustment. So I won't read it all to you. You guys can read, but you'll notice that never in the adjusting entry is there cash, and that always there's either an expense or a revenue. And that when there's an expense, there's an asset and a liability, a revenue on those. And then with the accrued, when there's a revenue, there's an asset, and when there's an expense, there's a liability. So that pattern seems like a lot, but if you think about it, there's really only 4 things to memorize there. Once you learn that, then it just becomes a matter of identifying what type of thing is this. So prepaid expense and unearned revenue, etc. And with a little practice, it becomes easy, right? After we do adjusting entries, we have to do what's called an adjusted trial balance. This is a process people often make more complicated in their head than it is. Honestly, all it means is with the adjustments, we've now made changes to the values or balances of some of the accounts. And so we have to find the new balance of those accounts and put them on the trial balance. That's all it means. And so, as you do those adjustments, you're just doing a T account and finding the new balance of that account and then putting that on the trial balance. So that's all an adjusted trial balance is. And once you've done your adjustments and you have your adjusted trial balance, you can easily make all of the statements from that information. You have your assets all together, your liabilities all together, stockholders' equity, revenue, expenses, all in one place. And then the last thing, closing entries. So the closing entries are based on the fact that we have accounts that we need to reset back to 0 for the beginning of a new period, a new accounting period. Those accounts are revenues, expenses, and dividends. And we can't just reset them. We can't just be like, okay, they're 0 now. Something has to happen to the values within them. And so what happens is they all get closed out to a permanent account. So revenue accounts, expense accounts, and dividend accounts, and the income summary account. These are all 4 accounts that are sometimes called temporary accounts because their balances get set back to 0 at some point. And asset, liability, and stockholder equity accounts, those are accounts we call permanent accounts because they have their value continues forward from period to period to period, or their balances do. So the way we do closing entries is we close the revenue account to income summary, the expense account to income summary, then the income summary account will have a balance after we've done that, and we'll close that to retained earnings. And the dividend account will have some balance, and we'll close that directly to retained earnings. And then that will leave each of these accounts with a 0 balance, and all of their account balance will have been transferred over to retained earnings. If you think about the statement of retained earnings, it shows the retained earnings at the beginning of the period, plus any net income, minus any dividends, gives you the retained earnings at the end of the period. So this closing process mimics that, because as we close revenue and expense to the income summary account, the balance of that account will become our net income, or the difference between the revenue and the expenses. And then as we close that to retained earnings, we're adding that net income to our retained earnings. Dividends will be closing to retained earnings, so we'll be subtracting those dividends from retained earnings. So that's the process of closing does exactly what the statement of retained earnings shows. So here's what they look like. So our revenue account, because that always has a balance of credit. So in order to close it, we have to debit the revenue account by the amount of its total balance. That will take the revenue account's balance down to 0. And then we credit income summary by that same amount. So that's our first closing entry, or closing entry 1 is always to close out revenue by debiting revenue and crediting income summary. The second closing entry is to debit income summary and credit all the expense accounts by their balances. Remember, expense accounts always have a debit balance, so by crediting the account by its balance, we're taking the value of that account down to 0. Then the income summary account is going to have a balance, right? Because we just credited the account 10,600 and debited the account 7,740.
Can I ask a question real quick?
Yes.
Okay, so for some reason it's throwing me off on the service revenue, because I think of revenue on, it has a credit balance.
Hmm.
Okay, so you put the credit balance in that column first, and then you went and debited it. Because we had the 10,600 balance, right?
Right. So let me see. I'm going to pull up. Maybe I'm going to pull it up. Come on, Excel.
And it's just because crediting is second that it's in the lower column. For me, I'm thinking, okay, you'd list what was there first, but you always do the left side first, right?
So I don't think so. I don't think, I think I understand what you're asking, and I think the answer might be no. So let me see if I can help. Or if
Okay,
all right.
thank you.
So at the end of the month, our service revenue account. Okay, I don't know what that is. Has a balance of 10,600 on the credit side. What in the world is happening? Okay, I don't know what's happening. So in order to close this out and take it to zero, we have to debit the service revenue account. That will now give us a balance of zero on our service revenue, and we're going to credit that to the income summary account. This is having a weird problem. I apologize for that. So we debited service revenue and we credited income summary. So there's our first adjusting entry.
I'm wondering if her question is, because I think we've talked about this, is in each entry for like October 31st, for each account. So for service revenue, you would enter the debit amount first, or the debit account first, and then the credit below that in each entry. So like on the income summary, your debit is first and then your credits follow.
Right.
And I think that was that your question, Jacqueline, like why the debit is first, because your debit entry is always first?
Yes, but it helps to know, okay, so it started with service revenue, 10,600, and then you debited that account, 10,600, to zero it out. And that then shows up on this sheet, this balance sheet, right? You put 10,600 as a debit to zero out that account.
Right. And then
And
credited it. Sorry.
No, that's okay. Then credited it on this sheet. Like I kind of
on income summary. So income summary is a special account we create just for the process of closing. It gets created by debiting the amount of by crediting the amount of the revenues and debiting the amount of the expenses so that we can find the balance. And then that represents our net income. And then we're going to close that out to retained earnings. So now we will debit income summary 2860 and credit retained earnings 2860.
So in my mind, and maybe this will help me, is I think, why don't we just put in there a credit of 10,600 and a debit of the 7740 on the expenses, and then we know right there. Like, it seems like we're doing a lot of double work.
I agree.
Okay.
Like, why not close revenue and expenses directly to income or to retained earnings instead of closing them to income summary, then finding the balance of income summary and then closing that to retained earnings?
Right, right.
I don't disagree with you. I'll be honest, I don't know the answer.
Okay.
It's how it's been done forever.
Okay. That just helps me to know that
yeah.
there's really not maybe maybe, I'm sure there is a reason, but that's what's happening and it helps me to understand that. So thank you for taking the time on that.
Oh, that's okay. I hope it was helpful.
Yes.
And so I think we're almost done. That was really longer than usual. I apologize. There's just a lot to cover in this chapter. I hope it wasn't too horrible. And then the last thing we do is we close out dividends directly to retained earnings. So the only reason I can think to do that is because in that process you do find net income, but net income is not that hard to find. I mean, we have it on the income statement. So anyway, okay, that's enough of that. Any questions about that, or specific questions about homework problems or quiz questions or other things you got stuck with? Like, we got stuck with all of it. We didn't ask for that homework, man.
I noticed this time we have a review, like an exam practice. I don't remember what the module is called. So I was just wondering, is that similar or different? Or I did the self-assessments last time from the extra content. Is that just another like additional source that's completely different from those? Or
it is. So yeah, so I don't know why they, well, I do know that for a while, like exam 2 was like this killer exam that was getting everybody. So at that point, the course designers put into the module material this additional like practice exam, or I'm trying to think what they call it.
Yeah, so I just looked it up. It's a practice quiz exam 2, and
Right.
it's worth 0 points. So
Right, yeah, it's just for practice, right?
yeah.
But it's similar in nature to those self-test questions I put in the additional material. So this one, just for whatever reason, like the course designers didn't used to have any of that in there, so that's why I put those self-tests in my additional material, because I feel like the wording is more close to what's on the exam. But they put this one in here, and then by doing that, instead of students being like, awesome, we get, why aren't those for the rest of the exams? And I'm like, I don't know. So the short answer to your question is yes, it is similar to the self-test stuff that I put out there.
Is this our hardest exam? You've made a couple questions or a couple comments about this one being pretty difficult.
So the data used to say yes, and what I mean by that is people, that was the lowest median score of all the exams. But since they put that practice exam in, and since I started telling people like, hey, be ready for this one, it doesn't really come out lower than the others. So so the short answer is, yeah, it's pretty hard, but maybe I should just give the short answer and that's it, huh? But it's very doable. People pass it and people get A's on it every semester, so you can do it. Other questions?
Do we have access to our past quizzes, or like even on the final, will we have access to our exams to go back and look at to see what ones we missed, or like?
Yeah, unfortunately, the answer is no. And it's a department level decision above my head. What they keep telling us is, this is like our biggest complaint by students every semester. So it's not, they're frustrated by the fact that they can't go back and see what they missed. And they keep saying, well, exams are for assessing learning, it's not part of the learning process. And I can see where they're coming from, but it's a frustrating response if you're a student who just wants to see what you missed. The best I can offer is I give you like some of you may have had me do that, where I in essence go back to the study guide and say, these were the concepts and these are the ones you missed, these concepts. So again,
Okay.
short answer, no, but
Okay.
long answer, there's a whole reason behind it that I may or may not agree with.
Okay, thank you.
Other questions? Because we've been here an hour, so I'm good to finish whenever you guys are. I don't want to.
Can you just one more time go over, like this question says supplies of 400 are on hand and the supplies account shows 1,600 balance.
Mhm.
So I'm not sure.
Sure. So let me
I
bring
would-
up, let me see if Excel will not be as weird this time. So we have supplies. And our balance of our account was how much? 1,600?
Yes,
So at the end of the month, we add them up. We actually go in there and like do a physical count of the supplies, and we have $400 worth of supplies. So we know that we must have used up a certain amount of them in order to end up at this point where we have 400. So we're going to do an adjusting entry to account for that, to recognize that we used up, and we can do the math in our head and see that we used up $1,200 worth of supplies during the month. So our adjusting entry would be to debit supplies expense, oops, $1,200, and then to credit the asset supplies, $1,200. Does that help or not?
yes, it does.
Okay.
Thank you.
Yeah, it's almost
I don't
like
know,
a,
for some reason, I just can't keep that straight in my head.
no, it's kind of like, because it's like a single variable algebra equation, right? Where you're like, know that you know you had this up front and this after. So how much did you use? And then that's the amount of the expense.
Okay,
Yeah.
thank you.
Okay.
I have one more question, and
Okay.
people don't have to stay if they're ready to roll, but so on the problem 4-7A on homework part 2 this week,
Uh-huh.
it was part B, and I was able through the video to figure this out, and I did talk to Leilani, one of the other students, about this, but I thought it might be good to have you explain this better to me. It took me a little while to figure out why on the first line, November 8th, it says paid 1220. Well, yours may say, we can just look at yours and discuss it. Oh, yours is the same numbers, I think, as mine.
Nice. That doesn't happen every time.
I know, I'm like, I think.
Let's see. So
My
paid.
other numbers are different, but
Okay.
so we'll go through them.
Okay, so we paid $1,220 for salaries due employees, of which 470 is for November and 750 is for October. And we're doing this on November 8th. So back at the end of October, we would have had to do an adjusting entry to recognize the amount of salaries and wages that had been incurred during that month. Okay, so I'm going to just do salaries and wage expense. So back at the end of October, someone did an adjusting entry that looked like this: 750 for salary and wage expense at the end of the month, and then a credit to salaries, oops, and wages payable. That was to recognize those salaries and wages that were earned during the month of October, but not yet paid. So then when they did their closing entries for the month, they would have closed out the salary and wage expense, taken it back to zero. But the salaries and wages payable would have remained because it's a liability account. So then we get to payday on November 8th, and we pay $1,220 total and on payroll, 470 which of it was incurred during November, and the remainder of it was getting rid of this salary and wage payable. So now we're going to credit salary and wages payable 750 to get rid of that money from October that we owed. And we're going to, I'm sorry, did I say credit? We're going to debit salary and wages payable to get rid of that liability we owed from October. And we're going to debit salary and wage expense for any amount that we've incurred during this current month. And we're going to credit our cash account because we're paying this out of cash. by the total amount. So that $1,220 in cash, if we were to put this into like, this is written in accounting language, if we were to put it into plain English, we'd say my cash went down by 1,220. 750 of that 1,220 was to pay off a liability from last month's salaries and wages, and the other 470 was to pay the salaries and wages that they've incurred so far this month. Does that help clarify it or not?
Yes, it does. Thank you. Yeah, that's really helpful. And it's also helpful to just maybe know how you read a problem. That sometimes I struggle to just kind of like, even just reading through these, the other ones were a little easier, but this one took me some time, to figure out what I'm reading. And I, at first I was like, okay, why am I dealing with October stuff? But of course, salaries payable should have told me that, but it took me a little bit, and your explanation was excellent. So thank you.
Thanks. So because of what you just said is why on those self-tests that I put in the additional study materials, I do a little video with them where I go through each question and like talk through my process. And some people think it really helps. Other people think it doesn't help them at all. So if that helps you, that might be valuable to you.
Okay, thank you.
Brother Fox, where do we find those self-tests that you narrate?
Sure. So if we come back to the course and click on modules and then scroll all the way down to the bottom where it's student resources, I have this little link to additional study content, which is honestly just a Google Doc that I throw stuff in there when I come up with other stuff. And then like for each one of these chapters, so like right now we're on chapter 4, right? We have self-test, and then right here is a self-test video walkthrough, which is like, it's long though, it's 25 minutes of me talking through each of those questions in the problem, or in the self-test. And then there's an additional self-test, some B versions of problems I've worked out in the past. Some of them are really long. And so, you can use like what you find valuable, and some people don't use it at all and some people do.
Is there any way that we can share that with someone else? I have a daughter who's in another class and was wondering if there was a way I could share those with her, just
Yeah.
right there.
So
Okay.
I think it will let you copy the link
Okay.
right there.
And that will be to all of those that you've got there.
Yeah.
Okay.
Yeah, I've shared this with other instructors. I mean, there's nothing proprietary about it. It's just stuff I've been teaching the class a long time, and I just sort of, as I come up with other examples, throw them in there.
Thank you.
Brother Fox, I was going to ask the example how you were showing the B problems in there. Are those going to be on the exams?
No, so these B versions of problems are closer to like homework problems.
Okay.
The self-test ones are the ones that have the look and feel, I guess, more of what the exam questions look like.
Okay.
And those, I mean, like I didn't make those. Those come from the textbook publisher, but they're
Yeah.
from the past version of the book, so the 7th edition or whatever. But they haven't made them for the 8th edition, so I'm like, I'm stealing those, and as long as they're out there, I'll link to them.
I did one today while I was at work. So I did it for chapter 3 and no, chapter 4, sorry. So wherever we're at, but it's helpful. It definitely is.
The problem with this course is there's so much required work that sometimes the thought of doing additional just seems overwhelming. And so I just put it out there for whoever can use it, I guess. Anyway, all right. Have I worn you down yet? Are we ready to say a prayer and get out of here? Okay. Any volunteers for a closing prayer?
I'm happy to say it.
Terrific. Thanks.
Our dear Father in heaven, we come before thee and thank thee so much for the opportunity that we have to learn and to develop our capacity to think and to reason. And we're thankful for Brother Fox and the excellent teacher that he is, and the time that he takes to help us understand we're grateful to be working with one another and the cooperation that we've experienced in this class. And we pray that each of us will be blessed with the patience to open our minds and understand what we're learning in this class, and that we'll be able to apply it in real ways in our lives, and also be there to help one another. We love thee and say these things in the name of Jesus Christ. Amen.
Amen. Thank you, everybody. Have a great night.
Thank you, Brother Fox.
Thank you.
Thank you. Brother Fox, quick question. Do you find that people who have a history in bookkeeping and accounting struggle with these foundational things, dependent on QuickBooks to do it for them?
Sometimes, you know,
That's what I meant.
no, and definitely like, you know, every semester I'll have students whose parents are like CPAs and they're going like, why do they make you learn all this? Like computers do all this for us. And I think they're just not thinking of the fact that they have a conceptual understanding of what's going on. And when there's an error, they have to dig back through the journal entry and find the issue. It's just, I remember like the first year I used QuickBooks, I would like enter an entry into QuickBooks, like in the check register, and then be like, did it really do the debits and credits to the right account? So I'd have to like go look in each account and see that it did it. So yes, to an extent, and for the worst is for people who are in banking, because for bankers, debit and credit have taken on very specific meanings.
Yes.
Yeah. And
It's killing me right now.
yeah, Monica's works in banking, so it's like having to relearn. Okay, debit and credit doesn't mean
Debit and credit.
it doesn't mean what I've always associated it with. I mean, it does, but remember, for a bank, any money a bank has represents a liability to them. If I deposit money at the bank, that's created a liability, so that's why it's a credit from their perspective. From my perspective, it's an asset. But from theirs, it's money that if it's in a checking or a savings, that they have to come up with on demand when I demand that money back. If it's in a certificate of deposit, they may have more leeway. But that's why those terms are used that way in banking, is because all cash on deposit at a bank is a liability to the bank.
I have great respect for folks who have to learn this in a second language, because it's a second language in so many ways.
It's crazy. You know, I don't know how they do it.
Yeah.
You know, yeah, anyway, every time I see them and I want so badly to make sure that they can get through the course, but there's limitations of just, they have to learn all the vocabulary first. And so you'll see them like looking at it in Spanish and then like being like, okay, so that's what that means. And I'm like, it's hard enough without that.
Right. And then there's the whole broadband issue.
Yeah.
Whether or not their area has good internet.
Yeah, our students in Africa, that kills them, you know,
Yeah.
problems with their proctorio exams dropping and stuff like that. And yeah, that's challenging. Anyway.
I will try to stop complaining about my own issues.
Yeah, we have a lot of first world problems.
Nice to have them.
Yeah. All right. Have a great night.
You too.
Thank you.